Today, I'm going to talk about the Savers Credit. I'm also going to show you how to save money on your taxes, and point out a mistake that's on the IRS website so you don't get confused and to make sure that you're saving the most you can, both in retirement and in taxes. If this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, Certified Financial Planner with Sickle Hunter Financial Advisors. The Savers Credit is a great way to save for your future into a traditional IRA, a Roth IRA, 401k, or another retirement plan, and also get a huge tax benefit. But you have to make sure that your income is at a certain level in order to receive those benefits. Now, before we get into those income limits, let's talk about what the Savers Credit can do for you. The Savers Credit can actually save you a few $1,000s in tax liability. So if you have a tax bill of say $4,000 or $5,000 at the end of the year, the Savers Credit could reduce that by up to $2,000. But your income has to be at a certain level. So let's go into those income levels and let's start there. So let's zoom into the chart behind me and let's take a little bit closer look at what you need to do in order to take advantage of the Savers Credit. Now, depending on your filing status will determine how much of the Savers Credit and at what income level that you can actually reach. So to look at this, let's take a look at this first column. This is married filing jointly. If you're married filing jointly and you're making less than $38,500, you could take up to a 50% contribution credit off of your income. But here's the catch. It's up to only $2,000. So what does that mean? If we take $2,000 and put it into a traditional or a Roth IRA, then that credit will reduce it if you make less than $38,500 or $38,500 or less, then you can also take a credit of 50%. That's $1,000. Now, if you and your spouse did that, you both contributed $2,000 into your traditional or your Roth IRAs, then you can reduce your tax liability by $1,000 for each contribution. So that's $2,000 maximum if you're married filing jointly. Those income limits go down significantly if you're single to $19,250. So you have to make $19,250 or less to get the maximum Savers Credit. But that doesn't mean you can't get any credit because there are other limits. At the 20%, it's $38,501 to $41,500. So if you make in between this range, then you can actually take 20%. So that would be $400 for 20% of $2,000. Now that $2,000 is the most that you'll get credit for. Doesn't mean you can't contribute more because you can. You're just not going to get additional benefit to the Savers Credit. And the highest limit for 2019 is going to be $64,000. So if you make $64,000 or less, you can at least do 10% of your contribution as a credit, which is still a huge benefit. Because if you think about it, if you put money into the traditional IRA, you're already reducing, or your 401k, you're already reducing your taxable income. So for example, let's say that you put $10,000 into your 401k, which reduces your taxable income by $10,000. So if you made $74,000 and you put $10,000 into that 401k, you'll have reached the threshold to at least get the 10% contribution. Now that contribution is only based up to $2,000. So that would only be $200 in a tax credit, but that's free money. So if you're saving into your retirement plan, not only is it reducing your total taxable income, but it's also going to help you offset that tax liability as well. And that's what the credit does. It's dollar for dollar on tax liability. Whereas the 401k reduces the dollars that are actually taxable. So you're getting kind of a double benefit there if you're taking advantage of the Savers Credit. I've explained how the Savers Credit works in other videos, but what throws a lot of people off is the IRS website itself, because I'm going to pull this up on the screen. If you go to the Savers Credit on the IRS website, it's flat out wrong. And here's why. So let's take a look at the Savers Credit from the IRS's website. If you look right here, and we'll zoom in to the Savers Credit. First, if you look at this line, and I'm going to highlight this here, the maximum credit amount is $2,000. That's actually incorrect. It's $2,000 from your retirement plan that qualifies in the calculation of the saver's credit. So you can't actually take $2,000 if you're single or $4,000 if you're married filing jointly. It's income that or contributions to the retirement plan that credit is based on. So it's actually worded incorrectly. The maximum credit amount is $2,000. It should say the maximum credit is $1,000 based on $2,000 that you contributed to a retirement plan. You wouldn't consider a traditional IRA or a 401k contribution as a tax credit. It would reduce your taxable income. So the closest thing it would be a deduction. It's not going to be a credit because a credit goes directly against your tax liability. So it's technically a $1,000 credit based on $2,000 of contributions. And it could be to a Roth IRA or a traditional IRA. So it doesn't even have to be pre-tax dollars going into just a traditional IRA. So again, it might be a little bit misleading. Apparently this has been on here for years and still hasn't been updated. So I don't have an answer from the IRS as to why it hasn't been updated, but that's flat out wrong. Also, there's nowhere in this description on this page that will tell you that it's only based on $2,000 worth of income unless you actually look at the form. So let's take a look at that. If we click on the form, and it's form 8880, and if you scroll down and look at line 6, in each column enter the smaller of line 5 or $2,000. And that's the line that's telling you that this credit is only going to be based on to the maximum amount of $2,000 and not more than that, which would give you a higher credit or what you would think you can get as a higher credit. So if you thought you could contribute $10,000 and take the 10% off to get a little bit more of a credit, you would be incorrect. The maximum you can do is $2,000 as far as the saver's credit goes. One of the biggest reasons that you should look at the saver's credit, obviously to get the credit, you also want to look at it when you're deciding between a traditional and a Roth IRA, because if you can get that little extra benefit by putting it into the traditional versus the Roth IRA, that might help you get a little bit more of a tax break. So you have to look at everything together and don't look at each piece independently. Look at them independently and together. There are 2 points that you should look at with the saver's credit. One is you don't have to just make $64,000 because you can make significantly more, but if you're putting it into 401ks, so if you and your spouse are both maxing out your 401ks, you can make significantly more than $64,000 and still qualify for the saver's credit. So it's really important that you look at what your tax liability will be after you save into it. And also, if you're looking at the traditional versus the Roth IRA argument, this is probably one thing that you should look at as well, because if you're close to the threshold, maybe it makes more sense to put it into the traditional IRA versus the Roth IRA. So that's one other thing that you should consider when you're making the decision of where you should put those dollars. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.